You're sitting on your couch, phone in your hand. You open your investing app. Just a quick check. The market moved a little today. You scroll. Your balance loads. $12,438. You stare at it for a second, because a few years ago, that number would have felt impossible. Back then it was $800, then $2,000, then $5,000. Each jump felt huge. You were excited, checking the app every day, watching the numbers move. But now, you look at $12,438 and nothing. No fireworks, no adrenaline, just a number. You close the app, and a weird thought creeps in. This is kind of boring. You've been doing everything right. Saving, investing, skipping things you didn't really need. And yet the result feels underwhelming. Meanwhile, your phone lights up with other options. Crypto charts exploding. Turn $500 into $50,000. Friends talking about trading. Ads promising passive income. Fast money. Exciting money. Money that moves. Suddenly, your slow investing strategy starts to feel outdated. Too safe. Too boring. Your brain whispers something dangerous. Maybe I should try something bigger. And this is the moment where a lot of people accidentally sabotage their wealth. Not when they're broke. Not when they're struggling. But right when things start working. Because real wealth, at the beginning, feels incredibly boring. No drama. No excitement. Just slow progress. And here's the uncomfortable truth. That boredom isn't a flaw. It's the entire point. The system around you is built to make boring money feel wrong. Because boring money doesn't generate much profit for anyone else. So the moment your finances become stable, the world starts offering you something more exciting. More activity. More opportunity. More ways to accelerate. And most people take the bait. Not because they're reckless. Because boring success feels suspiciously like doing nothing. But when it comes to building wealth, doing nothing well is often the entire strategy. Think of wealth building like climbing a mountain. The first part is steep, painful. Every step feels slow. You're saving small amounts, watching your balance crawl upward. And you expect that when you reach a certain point, things will suddenly feel exciting, like fireworks at the top. But the reality is stranger than that. When you reach the plateau where wealth actually starts growing, the environment changes. Everything becomes calm, predictable, quiet. That's where compound growth begins. But the human brain hates quiet success. We're wired to respond to action, movement, risk. So when things become stable, your brain starts searching for stimulation, which is exactly when the financial system steps in. Trading apps, hot stock alerts, crypto hype, options trading, new strategies. Everyone promising faster results. The financial industry doesn't make the most money when you quietly invest in index funds and ignore everything for 20 years. It makes money when you trade, when you switch strategies, when you chase something new. So the moment your finances become boring, the system offers excitement. And here's the wild part. Most people abandon the strategy that works because it feels too slow, not because it actually is. According to Dalbar research, the average investor consistently underperforms the market by several percentage points per year, not because they pick terrible investments, because they keep changing them. They chase performance. They panic. They experiment. In other words, they replace boring progress with exciting mistakes. So if investing ever feels dull, or slow, or uneventful, that's not a sign something is wrong. That's usually the moment things are finally working. My name is Peter, and I'm weirdly obsessed with how money actually works. Not the flashy version you see on social media. The real version. The one where quiet habits quietly shape your financial future over decades. Quick disclaimer before we keep going. This video is for education and entertainment only. I'm not a financial advisor. I don't know your personal situation. So none of this is financial advice. If you're making serious financial decisions, talk to a qualified professional. All right, let's talk about the two phases of building wealth, because almost everyone goes through them. Phase 1 is the grind. This is where everything feels intense. You're learning about money, cutting expenses, tracking your budget, saving your first few $1,000s. Every decision matters. You celebrate small milestones. Your first $1,000, your first $5,000, maybe your first investment account. Everything feels active, but phase two is completely different. Your system is built. You're investing automatically. You're saving consistently. Your financial life becomes routine, and that routine feels strangely anticlimactic. You expected excitement, but wealth building is more like gardening than gambling. You plant seeds, you water them, and then you mostly leave them alone. The trap appears right here, because when people reach this calm stage, they start questioning it. Am I doing enough? Should I be more aggressive? Is there something faster? And that curiosity opens a door to a lot of expensive distractions. Trading, speculative investing, constant portfolio changes. The system encourages this behavior. Brokerages send alerts. Apps gamify investing. Financial media highlights the biggest winners. You see someone turn $10,000 into $200,000 with a risky bet. What you don't see are the thousands of people who tried the same thing and lost money. Exciting success stories spread faster than boring ones. But boring strategies are the ones that quietly create most long-term wealth. Because the real engine of wealth isn't excitement. It's time. Time combined with consistency. And time works best when nothing interrupts it. Let's look at some simple numbers. Imagine you invest $500 per month into a broad market index fund. Assume an average return of around 7% per year. After 10 years, you have roughly $86,000. After 20 years, about $260,000. After 30 years, over $600,000. No stock picking, no trading, no excitement, just boring consistency. Now imagine someone else does the same thing but keeps chasing new opportunities. They switch investments, miss a few good years, sell during a downturn. They underperform a market by just 2%. That doesn't sound like much, but over 30 years, their final balance drops by hundreds of thousands of dollars. That's the power of consistency, and the cost of constantly interfering with it. Vanguard research shows something similar. Investors who automate and stick to simple strategies often outperform those who constantly try to optimize, because fewer decisions usually means fewer mistakes. In other words, doing less often produces more. Let me show you two quick stories. Alex and Jordan both start investing in their late 20s. Same income, same starting knowledge, same initial strategy. Alex enjoys the process. But after a few years, the routine feels boring. He starts experimenting, trading small positions, trying new sectors, following financial news. Every decision seems reasonable, but the constant activity slowly chips away at his returns. Some wins, some losses, lots of taxes, lots of stress. 10 years later, Alex has money invested, but the growth is slower than expected. Now look at Jordan. Jordan builds a simple system, automatic monthly investing, low-cost index funds, minimal changes. After the first few years, the routine becomes incredibly boring, which is exactly what he wants. He stops checking his account constantly, stops chasing trends, stops trying to outsmart the market. He just keeps contributing. 10 years later, the difference is noticeable. Jordan's portfolio quietly compounds, not dramatically, just steadily. And steady growth becomes powerful over time. Same income, same starting point, different relationship with boredom. So, how do you actually embrace boring wealth? Not by forcing excitement, but by understanding what the boredom means. Rule 1. Recognize boredom as progress. If your financial system runs quietly in the background, that's a good sign. It means you built something stable. Rule 2. Automate everything you can. Automatic investing removes the temptation to interfere. Less decision-making usually means better outcomes. Rule 3. Limit how often you check your investments. Daily movements create emotional noise. Long-term wealth happens slowly. Rule 4. Be skeptical of exciting opportunities. If something promises fast wealth, ask why it's being offered to you. The best investments rarely need aggressive marketing. And Rule 5, remember what wealth is actually for. It's not entertainment. It's freedom. Freedom to take risks in your career. Freedom to handle emergencies. Freedom to live without constant financial stress. Those things don't come from dramatic wins. They come from consistent stability. Because the real catch with wealth is this. At the beginning, it feels boring, but that boredom is exactly what protects it. The system around you is built to make money exciting, to encourage movement, activity, risk. But the moment you realize that boring money is usually the smartest money, everything changes. Protect your simple strategy. Protect your time horizon. And treat boredom like a signal that the system is finally working. Because real wealth doesn't usually look dramatic while it's happening. It looks quiet, predictable, uneventful, until one day you look up and realize all that boring progress quietly built something powerful.